Okay, I want you to picture the scene. It's what Donald Trump called Liberation Day. The atmosphere is, well, it's electric, but in that terrifying high-wire act kind of way.
Right, where you're not sure if they're going to land it.
Exactly. The U.S. president has just launched this massive barrage of tariffs against pretty much the whole world. But the crosshairs are locked, specifically, onto China.
It felt like the trade war to end all trade wars. I mean, we are talking about rewriting the rules of global commerce in a single afternoon.
And the market reaction was just immediate panic.
Oh, complete chaos. Stocks plummeted. Confidence in U.S. assets just fell off a cliff. The market hates uncertainty, and this was, pure uncertainty.
And in all that chaos, every pundit, every analyst, they all had one specific fear. They were convinced that Beijing, having just taken this massive hit, was going to retaliate.
And the one way that really scares Wall Street.
They were going to press the big red sell button on U.S. Treasury bonds.
The nuclear option, financially speaking, that was the prevailing theory. China dumps U.S. debt, they crash to the U.S. economy. Simple as that.
It's the sort of Damocles that's been hanging over the market for a decade. So the world holds its breath. We're all waiting for the dust to settle, waiting for the Treasury Department to release the data in June.
To confirm that China had finally declared financial war.
But then the numbers come out.
And it's a total plot twist. It completely defied the narrative.
It's like a classic detective story. Because when you looked at the data, the external enemy wasn't China, it wasn't Japan, it wasn't Europe.
Oh.
The call was coming from inside the house. Or, well, right upstairs, to quote the analysis we're looking at today. The killer was upstairs. It was Canada.
Our polite northern neighbor. The ones we usually associate with, hockey and apologies.
So that's our mission for this deep dive. We're going to unpack why Canada, of all places, dumped nearly $60 billion in U.S. debt in 1 month. We'll look at why China didn't sell and what this all signals for the future of the U.S. dollar. Because when your best friends start selling your debt, you might have a problem.
You certainly might. And to really get the scale of this, we have to look at the International Treasury Capital data, the TEEC data.
TEEC data. It sounds so dry, but this is basically the receipt for the American Empire's credit card.
Essentially, yes. It shows who holds American debt, who's funding the U.S. government, and in this case, the numbers are just staggering.
Okay, let's quench them. Because massive sell-off gets thrown around a lot. But put this in context for me. How big a move was this?
Okay, in April, Canadian holdings of U.S. Treasury bonds decreased by $57.8 billion.
$57.8 billion. That's a lot of maple syrup money. That's a serious chunk of change.
It's an immense amount for a single month. Usually, these fluctuations are a few billion here or there, portfolio rebalancing, that sort of thing. This wasn't a rebalance, this was a liquidation. And what makes it even stranger is when you compare it to the other big players.
Because usually in a global panic, everyone moves in the same direction, right? That herd mentality.
Exactly. But look at Japan. Japan is the largest foreign holder of U.S. debt. Did they run for the hills?
No. Quite the opposite.
They actually increased their holdings by $3.7 billion. So while Canada is sprinting for the exit, Japan is actually buying more.
Japan is doubling down. And then there's the big boogeyman, China, the country that was supposed to be leading the charge against the dollar.
The country the tariffs were actually aimed at. They're the third largest holder, right behind the UK. And yes, they did sell some.
How much?
About $8.2 billion.
$8 billion. Versus Canada's $58 billion? I mean, that's not even in the same ballpark.
It's a rounding error compared to what Canada did. For China, an $8 billion move it's pretty moderate. It's consistent with the slow diversification they've been doing for years.
So it's nowhere near the nuclear option everyone was terrified of.
Not even close. So you have this fascinating situation where the country being targeted, China, barely flinched. Meanwhile, the neighbor to the north is dumping bonds like they're radioactive.
And it wasn't just Canada, right? There were a few others.
A few. Hong Kong sold about $16 billion, Singapore sold $15 billion, but then you had the UK buying $28 billion, Belgium buying almost $9 billion. It was a mixed bag.
But the Canadian slice of that pie is just wildly disproportionate.
Precisely. Analysts from ING, Benjamin Schroeder and Pedro Garvey, they pointed this out. They said while the total foreign liquidation was somewhat restrained, only about $36 billion net, Canada's share of that was huge.
They basically drove the sell-off single-handedly. Yeah. Okay, so we've established the whodunit. It was Canada. Now we need to get to the motive. Yeah. Why? Why would Canada, America's closest ally, pull the rug out like this?
Well, you can't separate finance from politics here. The bond market doesn't exist in a vacuum. And the political tension between the U.S. and Canada at that point was, frankly, it was unprecedented.
It was nasty. I mean, we all remember the China tariffs, but Canada was in the crosshairs too.
From the very beginning, yeah, Canada and Mexico were singled out. But it went beyond just trade economics. The rhetoric was incredibly aggressive.
I remember this. The source material calls it virulent rhetoric. And the president wasn't just talking about trade deficits. He was talking about something existential.
Annexation.
The 51st state comments.
Correct. The president was repeatedly calling for Canada to be annexed as the 51st state, along with some pretty heavy accusations about border security.
I mean, can you imagine being the Canadian Prime Minister? You're sitting in Ottawa, and the elephant sleeping next to you wakes up and says, hey, I think I should just own you.
It changes the vibe in the room, doesn't it? It changes everything. It stops being about percentages and starts being about sovereignty.
And the source says this aggression caused a huge shift in Canada's national stance.
A huge shift. They've historically favored cooperation, but after this, there was a surge in a stronger sense of national identity, a sense that they needed to protect themselves.
And this all played out in their elections, too. Politics creates policy.
It culminated in the victory of Mark Carney.
Mark Carney. Now, let's pause there, because if you aren't a finance nerd, that name might not mean much. But in this story, he's a crucial character.
Hugely important. He's a liberal, a successor to Justin Trudeau. But more importantly for our story, look at his resume. He ran the Bank of Canada. Then he ran the Bank of England.
He's a central banker, a pure technocrat.
He understands the plumbing of the global financial system better than almost anyone. He knows how the gears turn, and he knows where all the pressure points are.
So you have a guy who knows exactly how the bond market works, suddenly leading a country that's being threatened with annexation.
Which brings us to the rumor mill, because there's a very juicy allegation here.
Right, and we need to be careful with this.
We do. This comes from a Canadian radio host, Dean Blundell, and disclaimer, this is not confirmed by official sources. We're treating this as an unverified rumor. But the claim was that Carney didn't just sell the bonds for economic reasons.
He threatened Trump directly.
The allegation is that Carney threatened a massive U.S. Treasury sell-off specifically to force the removal of tariffs.
So weaponizing the debt, drop the tariffs, or we crash your bond market.
That's the implication.
Wow, that is bold.
It's incredibly bold. It's the kind of move you usually attribute to superpowers, not to Canada. And look, whether it was a spoken threat or just a silent demonstration of power, the result is the same. $57.8 billion left the building.
It makes you wonder. We always talk about U.S. debt as a vulnerability, but usually in the context of China holding the leash. To see it potentially used by Canada, that's a paradigm shift.
And those analysts at ING noted this sell-off was unusually large. They're looking at the data saying, this isn't normal. It looks deliberate. It looks strategic.
It looks like a message.
It does.
So, if Canada's playing hardball, we have to circle back to the red herring. Why didn't China do it? Tensions were at an all-time high. Tariffs are flying. Why didn't Beijing dump their debt?
This is where economic reality just slams into political fantasy. It's the concept of mutually assured destruction.
But with money. Explain that for us. Why is China handcuffed here?
Well, Mark Williams from Capital Economics puts it very simply. Major Chinese state institutions hold at least $3 trillion in assets. A huge chunk of that is in U.S. dollars and U.S. treasuries.
Yeah.
If they dump their bonds, what happens to the price?
It crashes. Supply and demand.
Exactly. So if China sells, they are actively destroying the value of the portfolio they are still holding. They'd be burning down their own house just to annoy the neighbor. It's completely self-destructive.
But there's a currency angle too, right? It's not just about the bond price.
Yes. This is crucial and so often overlooked. Michael Brown from Pepperstone points this out. If China sells U.S. treasuries, they're selling U.S. dollars and buying their own currency, the yuan.
Okay, follow the money.
So when you sell dollars, the supply goes up, value goes down. When you buy yuan, the value goes up. The yuan gets stronger.
And China absolutely hates a strong yuan.
Right now. Yes. Think about their economy. They're trying to export their way out of overcapacity. They need their goods to be cheap on the global market.
A strong currency makes your exports expensive.
Exactly. So selling U.S. debt would be the exact opposite of what Beijing wants to achieve economically. They'd be hurting their own exporters at the worst possible time.
So they're stuck, they hate the tariffs, but they can't afford to fire the financial weapon because the recoil would knock them out.
Williams does note there's one exception. The only scenario where China sells everything is if they believe the U.S. is about to freeze or default on its obligations, like we saw with Russian assets.
If they think the U.S. is going to steal the money anyway.
Right. But we aren't there yet.
Okay, so China's holding steady because they have to. Canada's selling because they're angry. But there's a bigger, maybe darker cloud in this story.
Yes, there is.
It's not just about who's selling. It's about what happened to the market itself. Because the behavior of the bond market was weird. It broke the rules.
This is the part that worries economists more than the Canada spat, I think. It's the domestic weakness.
Right. Treasury Secretary Scott Bessent tried to downplay it. He blamed it on deleveraging by certain domestic investors, basically saying nothing to see here.
An attempt to calm the waters. But the data tells a different story about the health of the market. Usually you have this rule in investing, the safe haven trade.
The flight to safety.
Exactly. When stocks crash, investors get scared. They sell risky stocks and they run to safety. And safety usually means U.S. government bonds.
So stocks go down, bonds go up. The teeter-totter of Wall Street.
But that didn't happen this time.
What happened?
After the tariffs were announced, stocks plummeted, panic everywhere. But Treasury bonds also posted their biggest drop in more than 2 decades.
That's not supposed to happen.
Right.
That's like running into a fire station for safety and realizing it's also on fire.
It signals that the safety trade might be broken. And it wasn't a one-off. The source mentions another event, renewed attacks between Israel and Iran.
A classic geopolitical trigger. Usually, war in the Middle East sends everyone running for U.S. bonds.
Usually.
Ah.
But this time, Treasury bonds did not rally. They stayed flat or even dropped. It implies the world is looking at U.S. debt and saying, you know what, this doesn't look like safety anymore.
So why? What changed?
It's the fundamentals. It's the math. Doubts about fiscal sustainability. The source mentions the big, beautiful tax reform bill that passed the House.
Big, beautiful usually means very expensive.
Very expensive. It implies massive deficits. So you combine that with the existing $34 trillion in debt, then you add the political instability, and investors start questioning the long-term value.
So let's stack this up. You have rhetoric that scares off allies like Canada. You have trade wars. And then you have domestic tax cuts ballooning the debt, making the paper itself less attractive.
It's a perfect storm. Francesco Pisileo from ING notes that the expectation now is for a slow and uneven depreciation of the dollar.
Not a crash, then.
Not necessarily a crash, more of a slow bleed, a steady decline in relevance.
That's almost worse.
And when you look at the TPIC data again, it reinforces this. The data shows a struggle to find buyers for long-term government bonds. Allies are selling. Domestic investors are deleveraging. Demand is drying up.
It really flips the script. We spent all this time worrying about our enemies destroying the dollar. China is going to dump the debt. We didn't notice our own policies and our own allies might be the ones to stick a knife in.
That's the irony. The U.S. was looking across the Pacific for a financial attack, but the real liquidation came from the neighbor to the north, spurred by annexation threats and tariffs.
The classic case of misdirection.
And it leaves the U.S. in a very precarious position. Now, the total sell-off was restrained. $36 billion isn't the end of the world. But the correlation is undeniable. When U.S. political rhetoric gets aggressive, foreign bond dumping follows.
So here is where we leave you to think. We've unpacked the whodunit. It was Canada. We've unpacked the mood of annexation, threats, and tariffs. But the implications are going to linger.
Right.
If the U.S. Treasury market no longer acts as a safe haven during stock crashes or wars, and if even your staunchest allies like Canada are selling billions, here's the big question.
Go on.
Who is left to buy all this debt?
That's the problem. The U.S. government needs to fund those big, beautiful tax cuts. They have to refinance trillions. If China can't buy because of their economy and Canada won't buy because of the politics, who signs the check?
That is the trillion-dollar question.
Yeah.
And I have a feeling the answer isn't going to be as simple as it used to be.
I wouldn't bet on it.
We'll have to watch the next batch of tick data to see if this was a one-off or a new trend. For now, thanks for diving deep with us. Check the show notes. We've got the charts on bond yields so you can see that Canada drop for yourself.
It's worth a look. The visuals really tell the story.
Until next time, keep your eyes on the data.
Take care.